So good evening, guys. So welcome to the session for today. We're having approximately 250 participants in the session. And this session is completely centered around talking about the FCFF, the free cash flow to firm, and FCFE, the free cash flow to equity. So in my previous sessions, I have created some specific sessions and modules upon how to create the financial model of the enterprise, how to have the assumptions on the basis of that historical data, how to have the future assumptions and prepare the financial model of the company on the basis of those assumptions. So that we talked about. So though in my previous sessions also, I've tried to talk about the free cash flow to firm or the free cash flow to equity, and also talked about the terminal value approaches. But in these sessions, I'll try to simplify them in a much easier language and try to take in the different perspectives. So first of all, I'll share my screen to you. So once I share my screen to you, I'll be sharing a document from CFI, okay, the Corporate Finance Institute, and I'll be sharing the screen of that document, which clearly shows or like talks about the free cash flow to firm and the free cash flow to equity. Okay. So first of all, as I've talked about in my previous sessions also, I'll repeat the same thing. Okay. So first of all, we need to understand that whenever we are talking about the free cash flow to firm, it says cash flow available to firm, only firm. And what is the firm composed of? The firm is composed of the capital which is contributed by the equity holders as well as the debt holders. Correct? So what basically the firm is composed of? The firm is basically composed of the capital which is being contributed by both the equity holders as well as the debt holders. And that is why we call it as free cash flow to firm. Because free cash flow to firm is basically taking into consideration the total cash flow of the firm, which is available to both the debt holders as well as the equity holders. The cash flow that is available to all the capital providers of the firm. And there are two major capital providers of the firm, the equity holders and the debt holders. So your free cash flow, FCFF, is also called an unlevered free cash flow. And why do we call it as the unlevered free cash flow? We call it as the unlevered free cash flow because we are not taking into consideration the impact of debt into it. We are not taking into consideration the interest payment that we are making on debt. Because ultimately we want the total EBIT, earnings before interest and tax, the total profit that is available to both the debt holders as well as the equity holders. If we tend to subtract the interest payment of that, then like what will happen? It means that we have given the interest payment, we have paid the interest payment. It means the debt holders have been satisfied. The cash flow of the firm has been given to the debt holders, and what is left out is just available to the equity holders only, correct? But in this case, in free cash flow to firm, we are considered about all the capital providers, the total firm. So if we subtract the interest payment, it would be just the cash flow, which would be available to the equity holders only, but that is not the concern here. We are concerned about the total capital providers, and that is the reason we are taking into consideration EBIT and not subtracting the interest commitment or the financial interest payments. Correct? So we take the EBIT of the firm, we tend to subtract the tax rate, we add back the non-cash expenses. The non-cash expenses are your depreciation expenses, your depreciation charge on fixed assets, on tangible assets, and your amortization charge on your intangible assets. Then we tend to subtract your changes in your working capital. Changes in operating assets and liabilities is changes in working capital, and we tend to subtract the capital expenditure. So this is the first formula if we are given EBIT in the question. But if we are given cash flow from the operations, how to arrive at the unlevered free cash flow or the FCFF? If we add the tax adjusted interest expense, because ultimately like what we have done when we are calculating the cash flow from the operations, we have taken the impact of the interest payment. But as we all know, we do not have to take the impact of interest payment because we are talking about the total capital providers, the equity holders and the debt holders, correct? So in that scenario, we are adding back the tax adjusted interest expense. That is interest into 1 minus taxation, correct? Like what we are adding basically, your interest into 1 minus taxation we are adding back, right? Minus your CapEx. And if we are given the net income, again, we have to add back the tax adjusted interest expense because the net income is something where your interest have been paid out. We have to add back the interest. And since interest is tax deductible, we have to add back the tax adjusted interest expense. Interest का जो expense होगा into 1 minus tax का rate. That's it. Plus adding back the non-cash expenses minus changes in working capital minus capex. So these are the three ways in which you can calculate the free cash flow to firm or FCFF or unlevered free cash flow, right? And this I've talked about in my sessions on financial modeling, where I've used this model to calculate the enterprise value. Just take into consideration of free cash flow to firm helps you to calculate the enterprise value because you are discounting those future cash flows by the weighted average cost of capital or WACC or the overall cost of capital or just the cost of capital. Because your cost of capital, it takes into consideration both the cost of equity as well as the cost of debt. Hence, whenever we are having free cash flow to firm, we tend to discount it by the overall cost of capital to calculate the enterprise value. This I've talked about in my previous sessions as well. It is just a repetition. So we know that free cash flow to firm gives us the enterprise value. So what will the free cash flow to equity give us? Free cash flow to equity will give us the equity value of the company. Okay. So the second thing is FCFE, the free cash flow to equity. So in free cash flow to equity, as the name suggests, it is the cash which is available only to the equity providers of the company. Here we are taking into consideration only the equity providers and not the debt holders. That is why we are taking into consideration the net income here. That is, we have paid off the interest payment. So once the interest has been paid off to the debt holders are happy. And now we have to take into consideration the equity holders. So the formula is almost the same, but like just the changes, we tend to subtract the interest payment and taxes. Again, we tend to add back the depreciation and the amortization expenses minus changes in working capital minus capex plus net debt. Net debt is nothing but the amount of debt that you had raised minus the payment you have done. For example, like you have raised a debt of 100 crores and made a payment of 20 crores. Your net debt is 100 minus 20, 70 crores, which will be a part of this formula. The second formula is cash flow from the operations minus the capex plus the net debt issued. So these are the two formulas which help us to calculate the levered free cash flow. Why are we calling it as the levered free cash flow? Because it takes into consideration the impact of debt. Okay. So the one thing is your free cash flow to the firm FCFF, it does not take into consideration the impact of debt, but FCFE takes into consideration the impact of debt. Free cash flow to firm is also called an unlevered cash flow, whereas free cash flow to equity is called a levered cash flow. Free cash flow to firm gives you the enterprise value and we take into consideration the total cost of capital. But free cash flow to equity just gives you the total equity value of the company. And we tend to discount those values of free cash flow to firm by the cost of equity only, not the total cost of capital. That we need to understand. Okay. So that is again a very important thing that you need to understand. So if I go to my whiteboard, give me a second. Yeah. So I'll just share my whiteboard to you. Okay. So there is my whiteboard. So here I'm saying that whenever we are trying to calculate your enterprise value, we take free cash flow to firm. Because the formula, as I've told you in the previous session, FCFF1 in first year into second year and so on, and we tend to discount it by the overall cost of capital and we get your enterprise value. But in case of your free cash flow to equity, correct? We have different free cash flow to equity for year one, for year two, and so on. We tend to discount it by the cost of equity, right? And we get your total value of equity. That is the difference that you need to understand. Also, we also need to understand that whenever we are discounting it by the cost of capital, right? So here I'm talking about free cash flow to firm. What are the inputs in this cost of capital? The cost of debt and cost of equity we know. But we need to understand in the scenario of higher interest rates, as we can see in the present one, right? When the interest rates rise, again, this cost of capital will be affected. Why it will be affected? It will be affected because your cost of debt rises. The rate at which the firm would be taking loan from different banks, that rate would rise. For example, earlier, like 1 year back, the bank, like these companies would be taking a loan from bank at the rate of interest of 6% or 5.5%. But now the same loans interest rate have risen to 9% or 10%. So these banks get affected, and ultimately that rise in the interest rate gets encapsulated into this weighted average cost of capital. Ultimately, your risk-free rate is rising, right? Ultimately, your risk-free rate has risen. All these things are encapsulated into this weighted average cost of capital. And as a result, when this denominator rises, that is your interest rate rises, and as a result, your weighted average cost of capital rises, the valuations of the companies tend to get affected. And since the valuations of the companies tend to get affected, the valuations of the companies come down and they tend to appear cheaper. And in the opposite scenarios, when the interest rates are too low, so ultimately your cost of debt would be too low, the risk-free rate would be too low, and the weighted average cost of capital would be too low. And hence a result, your denominator would be less. And if your denominator is less, your valuations will be high, as we have seen in the previous time. When there was high inflation, the rate of interest were too low, and the valuations of the companies were all-time high. And in the present scenario, we can see the interest rates have become too high and the valuations of the companies have become too low. So majorly the high growth sectors tend to get affected in this rising interest rate environment. But high growth sector can be your information technology companies, IT companies, or startup companies, like which are high growth companies. So the valuation of these companies tends to come down, their share price tends to come down, and these kinds of sectors or industries, they tend to get affected when the interest rate rises. Okay, so that is the one kind of a difference that you need to know. But tell me one thing, we are concerned about the cost of debt only. That if the interest rates in the market are rising, the cost of debt will rise. Shouldn't we be concerned about the equity holders also? Aren't the equity holders taking risk in the market? How? The equity holders are taking risk in the market because they have invested into that stock. The market price of that stock can come down. Correct? So that is the first risk for that equity holder. The second risk for that equity holder is, since the equity holders are the last resort people. That is, if the firm goes into bankruptcy, if the firm goes into bankruptcy, who is affected? If the firm goes into bankruptcy, the first preference goes to the debt holders of the company. The second preference goes to the preference shareholders of the company. And if something is left, it goes to the equity holders. Only if something is left. Focus upon this point. Only if something is left. So aren't the equity holders also bearing the risk? The third reason, if the firm is taking more and more debt, the riskiness of the firm is rising. The bankruptcy cost of the firm is rising. The refinancing cost can rise, as we have seen in the case of Vedanta, right? Because the firm has to refinance its debt at a higher interest rate now, right? So all these things, so the rising interest rate, the cost of refinancing, or the cost of bankruptcy, which ultimately affects the cost of debt, it also affects the equity shareholders also, because equity shareholders are taking the risk to invest into the stock of those companies. They are the people who will get money at the end if the firm dissolutes or if the firm liquidates. the first preference will be given to debt holders, then preference in equity holders. And if the firm is taking like more and more debt, it is again a risk for the equity holders and cost of equity rises. So shouldn't the cost of equity be higher than cost of debt? Again, it's a matter of debate, right? Because the debt holders are facing just the risk of cost of bankruptcy, cost of refinancing, right? But the equity holders are facing like more risk as compared to the debt holders, right? So these things can be taken into consideration as well. But ideally, in most of the scenarios, your cost of debt, it tends to be higher than cost of equity. But we can still debate upon this scenario, should the cost of equity be higher than cost of debt, right? So these things we can have a complete argument upon these things, right? Then one thing also you need to understand that whenever you are calculating the terminal value of the firm, right? So what is the terminal value? As discussed previously, your terminal value is nothing but the final state of the company, at least at the end of 5 years, at which the company would become stable, right? So that is your terminal value. Now there are two ways to calculate the terminal value. One method is the most popular approach, like which is called the perpetuity method. Perpetuity method. So basically it says your free cash flows at the end of the year, into 1 plus the growth rate divided by what? Your cost of capital minus the growth rate. Okay, so basically they're multiplying the growth rate of the economy to the last year's free cash flow that they'll try to practically understand in the creation of that financial model divided by your cost of capital minus growth. So one thing you need to understand, cost of capital is something that you get from the cost of debt and cost of equity, and that we have learned that how to calculate the cost of capital also in the previous sessions. And the growth rate, how to take the growth rate. See, the growth rate of the company can either be taken in the form of the GDP rate of the economy. Like for example, if the GDP is like 4% in the current year or expected to grow like by 4.5% or 5%. So either you can take the GDP growth rate, right? If not, then you can take the average growth of the GDP in the last 5 years as the G figure, or you can take the expected GDP growth. Further, the analysts also tend to take the average growth rate of that particular sector. Like for example, if I am preparing the financial model of IT company, and I believe that IT company has grown at an average rate of like 20% in the previous years. Okay, so I'll take the previous 5 years growth rate of IT companies and take the average of that. And if I believe that IT has risen by 20%, average rate, I'll take 20%. Provided your cost of capital must be more than the growth rate. And we also have to exclude the extraordinary circumstances. As in 2020, the IT companies grew by like 174%. So like because of that, the growth rate can be inflated. So that year we can exclude, right? So that we can have an average good number. Same we can do for the healthcare industries also, right? And for example, if you're doing for a tourism company or healthcare, not a healthcare, a tourism company, right? So that COVID period can be excluded because at that time these companies face too negative growth, right? So these abnormal periods can be excluded while calculating this average growth rate. Also, there is a formula to calculate your growth rate. It's the Buffett formula. This Buffett formula we have studied in the extensive valuation modules. That is nothing but your return on equity into 1 minus or simply your retention ratio, right? So for that particular company, whatever is your return on equity, okay? So for that particular company, I'll just erase all this. So for that particular company, what has been the return on equity, we can just multiply it by the retention ratio or 1 minus dividend payout ratio. Again, it will give you the growth rate, right? So that is one thing that we can try to understand about the growth rates. Okay. Then there is one more thing that we can use. The one more thing that we can use is what? We can take your EBIT divided by your CapEx plus change in your working capital requirements. EBIT into 1 minus tax. First, those formulas like were like regarding the GDP of past 5 years, the GDP forecasting of future years, the current GDP. So apart from that, the mathematical formulas I'm telling you. One is your the Buffett ratio, we call it. The first one we tend to call it as the Buffett ratio. It says the return on equity into the retention ratio. The second one says your EBIT into 1 minus tax divided by your CapEx plus change in working capital. This formula also gives you the growth rate, right? This formula also gives you the growth rate. So these two formulas you can plan to use. And this formula for EBIT into 1 minus tax by your CapEx and changing working capital can also be used for the new companies, the new age companies whose EBIT is positive, because here we are not taking into consideration your interest payments, right? We're not taking into consideration your interest payments. So hence we can use this formula to calculate the growth rate, right? So these things is like you always have to keep in mind. These two formulas are the most well-known formulas that can be used. Any queries, let me know. Okay. So see, whenever also, so like this is the first method as I told you, your FCFF into 1 plus growth rate by your cost of capital minus the growth rate. So that is the first method. So to continue with the thing, like before we start with the second method, because the second method like won't take much time. It is the least commonly used method. If in the question, right, the risk-free rate is not mentioned. If you don't have the risk-free rate for an economy, how will you assume that risk-free rate? Again, this is a very important component to calculate the cost of equity because that is used in the CAPM model also. And that is why I was saying the risk-free rate is an important ingredient in calculate the WACC also, right? So what you're gonna do, you're gonna take the expected rate of inflation in the economy, expected inflation, and you're gonna add the expected real interest rate, real interest rate. Expected inflation may add expected real interest rate, you will get the risk-free rate. Similarly, if you want the nominal growth rate in the economy, nominal growth rate, what is nominal? Which excludes the impact of inflation. Again, you can take what? The expected inflation, and you can add the real growth rate to it. So this is how you can calculate the nominal growth rate. Okay. So now the question arises in the valuations. Should we the risk-free rate that we are using, right? Or basically like for the growth. Okay. So like when we are using the growth rate, should we take into consideration the nominal growth rate in that FCFF ka formula or the real growth rate? Ideally, some people tend to use the nominal growth rate, but I prefer using the real growth rate because that is adjusted for inflation. Because I want to have a clear picture for the financial model that I'm making. Okay, so that is my interpretation. Okay, so that is the thing. So that is the first model that we talk about. That was the perpetuity model, the free cash flow to firm, which basically said you whatever is the last free cash flow of the firm into 1 plus growth rate divided by your cost of capital minus your growth rate. Okay, if it is free cash flow to equity, this will be changed as cost of equity and not the cost of capital. So that is the first formula that we know. The second formula is your multiple method. Multiple method. Like if we want to know the targeted valuation or the targeted terminal value of the company, it basically happens. You might calculate the net income of the company in the current year, maybe $20 million. Okay, or maybe like 20 crores because we are Indians. Like let's talk about CRs and INRs. Okay, so it can happen And then net income, the current net income of the company is 20 lakh. Yeah, just 20 crores. Okay. An exit PE multiple or a PE multiple might be given, a forecasted multiple, or it can be the average multiples of the similar companies within the same industry. Like, for example, if TCS had made a net income of 20 million, average forecasted P multiple of all the similar companies, the TCS, Infosys, Mindtree, like the average, the P came out to be 20. Okay, so like what they will do to calculate the terminal value, they will multiply this 20 million with the 20,000. Comes out to be 400 crores की valuation, the future terminal, not the valuation, the future terminal value of the company. But this method is really used. But perpetuity method is more ideally because यहाँ पे क्या है कि the net income that we have calculated for the current state is 20 million. The average PE that we have taken from the similar company, the average PE of the company, like that we have taken for a similar company, forecasted PE of 20. 20 into 20 we did, that is 400 million. Correct, but it have not taken into consideration your growth, the weighted average cost per capital. These things are very important to be taken into consideration for valuations. Hence, I do not refer this method in general. I prefer the perpetuity method. Any queries that you know? I'm waiting for a while. Okay. So in your forecasting method, like one is the perpetuity method, the most well used model, and the second one is the multiple method. Like for example, the company is having a revenue of 20 million, and if you a company or like a person that would be exiting the company after 5 years, is valued at a P multiple of 5. So again, like it would be 20 into 5, like 100 crores, right? So this method is majorly used for the venture capital startup companies, right? So that is the major agenda of the session where I wanted to differentiate between free cash flow to form and equity, talk about perpetuity and the multiple method, also talk about the WACC, the risk-free rate, and the growth. Any questions, what is more than welcome to ask, please. Okay, hello then. Thank you guys. Thank you.